Well, thank you very much for the kind invitation. Am I standing between you and lunch, or do you still have one more speaker? Okay, so I'm not quite as annoying as that, but then as an economist, I am used to be rudely interrupted and say you must really, if there's something unclear as we go along, you must just stop me and redirect me. Now, where the previous speaker was, I think, very close to where the lawsuits in South Africa happen, and to quite exciting stuff. Us economists are very often more into statistics, and I know that you as journalists will have to report on these statistics and information in a responsible way. And I hope in the presentation to give you a few pointers towards, in a sound way, reporting on the all-important credit extension. So all of us have some form of debt, I guess, and I would love then to highlight some of the information which the Reserve Bank has available and which we publish also in the quarterly bulletin regarding credit extension, how to interpret it, and also then some of the trends which one can observe currently in this rather interesting and sometimes sad area of our existence. So I'm going to talk firstly about the key aggregates and their trends, the drivers of credit extension, the stocks and flows, trying to fit all of this into half an hour. A few words on the household debt measure, which we also calculate, and what the household balance sheet looks like, and before are we concluding. So I don't know how many of you have already perhaps dealt with the Reserve Bank's quarterly bulletin or with the monthly release of selected data, which is a kind of a one-page summary document which appears on our website, and it's also available in printed copy for those still interested in that, which just gives a brief overview of the money supply and credit extension. Any of you who've already worked with a quarterly bulletin, except for my one colleague over here and my two colleagues over there? Yep, some of you have indeed. So lots of statistics, quite a few graphs, some write-up, but probably I hope I can still give you some pointers on how to deal with the credit extension side of things. So in South Africa, we have good credit extension data going back to 1965 on a comparable basis. We also have more partial information going back, way back until the early 1900s, in fact. But for the current wider and more sound set of measures which we have, it's quite important to know what the measure really means. What do we measure? And the nice thing for economists is we would love to have really up-to-date information on the economy, and there the bank's balance sheets are really quite helpful. Because banks, because of their kind of business, have to keep their statistics quite up-to-date. They really must know how much money is in your account from day to day. If they don't, they're probably a pyramid scheme. And so we can extract information from them on a monthly basis with minimal delay and get a view on how the economy is doing just by looking at the banks, because everybody does transactions using the banking system. So in looking at bank credit extension, we look at balances outstanding. It's not a flow concept, it's the balances outstanding. We measure it from the banking sector's balance sheet, and that banking sector, well, the big fish in this banking sector is the banks. The ordinary banks registered under the Banks Act, and then there's also some tiny little mutual banks. That's not a really great deal. The land bank is also in the sector which we monitor. The Post Bank is also there, so it seems that the moment the word bank is somewhere in there, it's part of the group. The South African Reserve Bank itself is also there, and then the Corporation for Public Deposits, that not many people know of, but that's a kind of a side operation of the South African Reserve Bank, which takes public deposits, and it also invests some of its monies into various forms of value paper like treasury bills and Transnet stock. So in looking at the balance sheet of this entity, the banks under the Banks Act actually constitute 95% of the total aggregate of credit extension. So it's mainly the banks, but all these side things like the Reserve Bank, the Land Bank, and so on kind of add up because it's possible to substitute the one kind of credit for the other. It's necessary to capture the whole rather than just the partial portion of that. And I think it's kind of quite important to note that at the Reserve Bank, when the monetary policy deliberates on whether credit extension is going slower or is accelerating, and whether it seems dangerous or not dangerous, they look at this first friend, total loans and advances to the domestic private sector. That's actually the prime measure. Strangely enough, but in financial reporting, you will very often find that people look more at this total claims on the domestic private sector. Now, that used to be the measure of credit extension that got most publicity for perhaps the first 20 years from 1965 to the middle of the 1980s. But at that stage, people started to figure out that there's some things which are quite jumpy in this total claims on the domestic private sector, on the asset side of the balance sheet of the monetary sector. Now, these investments always sounds like it must be something real physical. It must be a house or it must be a building. No. In this instance, what is meant is financial investment into value paper of the private sector. So in other words, if a private sector company like Barlow Wills issues, say, bonds, and a bank purchases those bonds, it's in this investments category. It's kind of financial investment. The other one is this bills discounted, that's short-term IOUs issued by the private sector, also owned by the banks. Now, if you kind of take the loans and advances, plus investments, plus bills discounted, it brings you to total claims on the domestic private sector. But sadly, these investments and bills discounted come with a footnote, and so we don't actually think that they are that helpful in analyzing true credit conditions. But if you want to go wider still, you can also add net claims on government, which is claims on government of the banks. That's where ABSA has, let us say, government bonds, which it has purchased. So that's the claims on government, minus government deposits. As you know, government also has a deposit account with many banks, including the Reserve Bank and with the big four banks. And so if you take claims on government minus government deposits, it gives you this net claims on government, and that brings us then to so-called total domestic credit extension. So in the quarterly bulletin, and also in this monthly release of selected data, you will find all of these concepts, but believe me, the important one is the first one up there. Let me just give you a quick indication why those investments and bills discounted are not that helpful. One wants to understand where the economy is going, and the economy is a little bit like a big ship. It takes time to turn its course. Credit extension, the same thing. It's kind of supposed to have a gradual pattern, but these two friends, investments and bills discounted, are very, very choppy. They really go up and down all the time. So it includes derivatives under the investments category. And derivatives, as you know, are contracts of which the value can change quite excitingly from time to time. And so from month end to month end, they get revalued, mark to market, as they say, and that makes it a very choppy series. So it can go from more than 100 to less than 60 very quickly and then jump up again. So it imparts, if you add it into the credit aggregates, a kind of jumpiness which is not really helpful and not representative of true credit conditions in the economy. To a lesser extent, the same applies to bills discounted, which is anyway quite minor in the greater scheme of things. So this is then the picture of loans and advances to the private sector, and this one now goes back to 1966, right through to where we currently are, and you can see that we've had quite exciting changes in the tempo of growth of loans and advances to the private sector. Please note the numbers here are the year-on-year percentage changes, the rate of growth in credit extension. Now, people very often now ask, what do you want? What is a good number? If it is, as it is currently, 5-6%, something like that, perhaps in that vicinity. Is it good news? Should it be more exciting as we had over there? Should it be as exciting as over there? What does one really want? I guess if that's a very flat line at a very low level, that would indicate a very dead economy. So you don't want that. You actually want credit extension to go on. Banks should be extending more and more credit for a growing economy where more and more transactions happen, where more and more people own houses and borrow in order to acquire those. So, but clearly if the party is too hot, it creates its own little problems. The credit extension flows over into money creation and it flows over into inflation at some point in time. And so for all of those reasons, kind of an intermediate level of growth for credit extension is probably not too bad. If one has to be really creative in making some numbers, if you look at South Africa as a country with a potential growth rate of, say, 5%, it's a bit optimistic, with inflation also of about 5% in the longer run, then something like a 10% pace of growth in nominal GDP seems to be acceptable. And that would mean that money supply and credit extension over the long run should also be growing at something like 10%, perhaps 12%, something in that vicinity. So, but as you can see, we have had much more exciting times over here. And you also won't be surprised to learn that during the 1970s and 80s, we had double-digit inflation for most of the time. I think I'm going to just reflect a little bit on some of the drivers of credit extension, what makes it grow more rapidly and sometimes less rapidly. And here, must say, one should never ever believe an economist when he tells you that there's just one factor driving some other factor. No, life is more complex than that. Expectations, confidence, world GDP, prospects, house prices, there are many things which fuel credit extension. But in this instance, I chose just to show you the relationship with the prime lending rate. And let's just look at the most exciting episode of credit extension which we had, which was in the early 1980s. Now that was kind of a perfect storm, I must say, because previously, during the late 1970s, we had credit ceilings. That meant that there was a regulation which told Absa Bank, it was then called by a different name, but Absa Bank, look, you've got 500 million rand of credit on your books. Somebody must first repay you before you can extend a new loan, because the total amount which you can have outstanding at every moment in time is 500. So that was a credit ceiling, a credit limit, which was used to contain credit extension at the time and try to get inflation under control. Didn't work particularly well. Direct controls generally are not a very good plan. And so it did not really work very well against inflation. But anyway, it kind of diverted credit into the grey market around the banking system. Now, you can perhaps force the banks to abide by those rules, but they cannot prevent the son-in-law from borrowing from the father-in-law, or the one company in the group from borrowing from another company in a group outside of the banking sector. So the credit ceilings created all kinds of parallel markets and troubles, and it was not such a good plan. In 1980, however, the credit ceilings were abolished. Now, think of it. Previously, people went to the banks and asked them for a loan, and the bank said, I think you are a very credit-worthy person, sir, but unfortunately, we have this credit ceilings, we cannot give you the loan. And so people had a pent-up demand for credit, and in 1980, the credit ceilings were abolished in September of the year. At the same time, the prime lending rate was pretty low, given the inflation of the time, which was double-digit inflation. And at the same time, the gold price, for those who still remember those days, the gold price was way up there. At that stage, way up for the gold price was, actually it went up to $800 per ounce. Currently, it's almost double that, of course. But believe me, in 1980, that was a very exciting price. So the money was flowing into South Africa from abroad, bringing liquidity. The whole country was flush with liquidity. The interest rates were very low. and there was this pent-up demand for credit. And so, zhoops, up went credit extension to a really large extent. So, bottom line, low interest rates with perhaps a little bit of a lag fuel credit growth, as one could expect. It's kind of a very cheap option to borrow more if the interest rates are low and your expectations, for instance, of house prices are high. Vice versa, if you have high interest rates, as we had over there in 1984, it takes a bit of time to work through, but it kind of whacks credit on the head with a bit of a lag, and then the credit extension slows quite dramatically. Another example of the same is over here, the 1998 escapade, when we had the Southeast Asian financial crisis, when interest rates in South Africa were lifted quite a bit. The prime rate at the time went to 25.5%, and that kind of whacked businesses and homeowners on the head in a most annoying way, and it created credit extension conditions which were very subdued thereafter. So credit growth, with a bit of a lag from there, came down really forcefully to very, very low levels given the circumstances at the time. Okay. More recently, the low interest rates of that episode over there actually fueled these increases in growth in credit extension. Similarly, after all these little increases in interest rates over that episode, from 2006 onwards, it actually started to work, and it brought the growth rate in credit extension down quite nicely. But for that last episode, I think it's quite necessary to just mention a few other factors which also had a bearing. I mean, quite importantly, this big financial crisis, the global financial crisis of 2008, the Lehman crisis, it was a very exciting event. It certainly destroyed confidence on a scale that one cannot believe, and it spilled over into many markets right through the world, including to South Africa. It also created an impression that where previously property prices can only go up and share markets can probably only go up or sideways, no, these things can actually come down. And that was then not very helpful for credit extension. It certainly also helped to propel it downwards. There is another factor which I think is playing a role right now and will probably continue to play a role for a long, long time. And that's the National Credit Act, which, as you probably remember, came into full operation, I think, in 2007. But this National Credit Act kind of made lenders much more cautious before extending a loan, knowing that if they extend a loan and they kind of capture a client, the innocent client, in the clutches of credit extension, now you'll have to prove that a due process was followed in evaluating the client if you want to recoup the lost money. And if you cannot prove that due process was followed with enough caution, then the lending institution is in trouble instead of the borrower. So that really made institutions in the lending business much more cautious than before. For all of those reasons then, so far, despite the lowest interest rates in 30 years, you have to go back to years to observe the same kind of interest rate levels, despite that, the credit growth so far is really quite subdued. The economy is actually growing not too badly. The latest growth number, as you remember, was 4.8% for real GDP for the first quarter of this year, which is not bad. But the credit extension is really quite slow. And there are quite a number of structural reasons why this is probably going to continue, perhaps not at the current really low levels of increase, but my take would be that a pick up to something as exciting as we saw over there, or over there would not be very likely. Just to show how miserable in a way the typical borrower and the typical lender currently feel, so they really don't, those who want credit don't want too much, they're much more cautious. and those who want to lend out, they don't want to lend out too much, they are all a bit cautious. Because of that, we find that in the current cycle, the growth in credit extension is really slow. This graph shows for a number of economic cycles where there were recessions. In other words, shrinkage for more than 2 quarters in real GDP. In those instances, what happened to credit extension? Where this is the moment where the GDP started contracting, and if you then take that as the kind of middle point of the graph, you'll see that for the red line, for this latest upswing from 2008 in credit extension, it has actually swung down, and only started growing very, very slowly subsequent to the turning point after 5 or 6 months. And it has been a very, very slow thing. Whereas previously, in the previous cycles, in all instances, things were a bit more lively. So clearly, the rules of the game, including the National Credit Act, and the caution imparted by the horrible experience of 2008, 2009, dampen credit growth currently, and will probably continue to last in the brains of South African borrowers and lenders alike. And what's kind of interesting is also that this is despite really low real interest rates. It's not as if the current interest rate environment is not stimulated. It's really quite stimulatory. If you look at the previous events in 1998, what distance we had between the interest rates up there and the inflation rate, the real interest rate was really biting very hard. Even over a year, it was still quite high. Whereas in the current situation, we really find that the real interest rate is extremely small. It's really a small positive only. And actually, if you use forward-looking inflation expectations rather than backward-looking CPI to adjust, you will actually find that we are running negative real interest rates. Okay. Well, I don't have that much time, but let me just show you 1 or 2 splits of loans and advances growth, which analytically hopefully could be interesting or useful in your dissemination around the topic. The one is just to look at the split between households and companies. And over here we find that over the past cycle, household credit growth at least has been in positive territory. So banks continue to lend more money to households at a very slow pace of increase, but nevertheless the outstanding balances were creeping up all of the time right through. So, and the big savior there was actually mortgage advances, which continue to creep up kind of slowly. As for companies, post-Lehman, business really collapsed. Things were quite horrible. So businesses contracted their inventories, and businesses stopped investing in plant and machinery and so on. So real fixed investment or the purchases of machinery and equipment and the like, it really came down quite forcefully post-Lehman. Under those circumstances, with companies contracting and selling less and economizing on their inventories, they have less need for finance, and the bank sure felt that. So here we actually found in a contraction in the bank's outstanding loans to companies during this period, and it has only been in the past more or less 8 months that again the companies have started to borrow more from banks, at least on a year-on-year basis. So, well, all bad things also come to an end, fortunately. And so the inventory cycle, which went down all the time, in the past 2 quarters for which we do have statistics, that really started to go up again. So that demand for credit to finance and carry inventories has started going up again. And there's been a little bit of growth in fixed capital formation too, which also kind of pulls up the demand for credit amongst companies. However, sadly, companies don't just use credit to purchase inventories and to do fixed capital formation. They can also use money which they borrow from the banks to pay their taxes, to pay their staff, and to do takeovers and restructurings. So unfortunately, the motives behind companies borrowing, the same as the motives behind individuals borrowing, you cannot read from the numbers. You do have some other macro variables that correlate well with it, but unfortunately, very often there's a jump in the numbers which is not really explained by ordinary economic trends of the moment, but it's really something special. A corporate takeover, a BEE transaction which has taken place and which is financed to some extent with bank credit, or just a sudden big tax assessment which ends up on the desk of Company A, and Company A then goes into overdraft in order to pay it. Right. Then, another way of looking at credit extension is by type of advance. So now it's not companies versus individuals, but the kind of product which the credit extension is packaged into. And the main ones are mortgage advances, which is really quite important in the South African context, and which has never gone into negative territory in the recent cycle. So we still have mild positive growth in mortgage advances. Then installment sale and leasing finance. Okay. You know what that is for. That's the old hire purchase agreements, as you probably would have guessed. And so that would be typically motor vehicle finance, or the financing of things like refrigerators and ordinary consumer durables. So those things are financed through installment sale and leasing finance. And actually that variable correlates very well with the general business cycle and with how much expenditure is taking place in the economy. So, and it is kind of nice that that golden line and the blue line have both turned around on the graph, and we see them now picking up again. The other loans and advances, that's the golden line, is actually a combination of quite a number of kinds of credit. But it would include credit card advances, which is, by the way, not a very big portion of the total book of the banks. If you look at the aggregate value, it's actually fairly tiny. But of course, it's extended to many, many people. Relatively small loans, but many of them. So credit card extension is in there. Also, ordinary overdrafts is also with other loans and advances. And then a category which we call general loans and advances, which would be project finance, personal loans, and so on. Not on an overdraft basis, but all the others. So all of those go into this. And as you can see, all of them are currently in positive territory, at least growing again, after they have been in the doldrums for a rather horrible year or year and a half. Okay, well, one of the reasons why the mortgage advances are relatively subdued, growing at quite slow rates nowadays, has to do with the fact that the property market is not too hot. With house prices actually going nowhere, there's not that much enthusiasm to borrow to the hilt in order to acquire a house. That expectation that you'll become a mega millionaire very quickly by seeing the house appreciate under you, that perception seems to be no longer in most of the investing and home owning community. And so that has not enhanced the demand for credit for mortgage advances at all. I think let me quickly then turn to one or two slides on household debt. Again, perhaps because this is often reported on, and reported on with a number of perceptions which are not fully correct. So this is household debt and household debt service cost. What does it really mean? Well, household debt at the Reserve Bank, we look at bank credit extension, but when we also consult other sources in order to find other ways in which households obtain credit. So this would be going to non-bank financial institutions like BMW Finance or Nissan Finance. There are these car companies which have these schemes. There are some retailers who also have credit schemes where people borrow quite a bit of money. We have the micro lenders outside of those who are incorporated with banks, also quite important. And we have the indebtedness of households towards municipalities, for instance. So there's actually fairly substantial amounts of outstanding credit to households in that way also. We get information on all of those from a variety of sources. We aggregate it, and in that way we then get total household debt. Now that household debt, in its own right, of course it just goes zoops up all the time, in nominal terms at least. But in order to make sense of it, it's quite handy to express it relative to income. So you actually look at people's after-tax income. The disposable income is just economists speak for after-tax income. So you calculate the household sector's after-tax annualized income, and that's when what we have on that top line is household debt outstanding divided by household annualized income. Kind of important here is to note that the debt is a stock, so it's an outstanding balance. You measure it on a single day. It's the end of December, that value outstanding on the balance sheet of the households. Kind of just aggregated for all the households. You get that number. You divide it by the household income, which is a flow concept. So like your salary, which is payable per month or per annum. So it's that stock overflow, and now sadly, quite often I have seen reported that households now have debt outstanding which is such that they have to pay 80% of their income towards their debt. Now that is not really true. Now, the household outstanding debt stock perhaps is 80% at the peak point over there, or 82% of household annual income, but that does not really mean that you have to pay 82% of your income towards servicing your debt. You must pay that to the bank. No. Of course, cumulatively over time, as you get rid of your loans, you will have to pay as such. But in the meantime, the debt service charge which you have to face is quite a bit less exciting. It's this debt service cost, which is actually interest divided by income. And as you will see, this debt service cost element is much more tame numbers. It's 14% there at the top, and currently it's something like 7% over here. So 7% of people's income go towards servicing their debt, which is much more tame. Now, of course, the top line has trended up over time, as you can see, and people are currently actually still quite heavily indebted in a historical context. That ratio has crept up over time, and that has been one of the features of our economy, that people have become more debt accustomed or debt exposed, if one wants to call it that. And that's currently still quite high at something like 77% of 1 year's income, which you have as outstanding debt. But heck, think about this. If I buy a house, then most probably at that moment when I go to the bank and I borrow the money to get that house will be 3 times or twice my annual income. So my outstanding loan to the bank, the moment that I purchase that house, will be much more than 77%. It might be 200% or 300% of 1 year's income. And is that such an unhealthy thing? Probably not. If it's for home ownership, rather than for having the nice holiday in the Seychelles, then that borrowing is actually a very sound and healthy thing. So those who say that a lower household debt ratio is always good, and a higher one is always bad, should perhaps just take note of the argument that if you want home ownership or entrepreneurship and people extending their farms or picking up their one-man businesses, extending their businesses, all of those would actually love to have a higher debt to income ratio, and that would not necessarily be unhealthy. The variable down there, interest paid over income, there you have a flow over a flow. and it is kind of more easily comparable. And the reason why this has fluctuated up and down so much over time has mainly got to do with the interest rate. So you can see again that 25.5% interest rate nicely represented over there. The tight conditions of 2007, 2008 over there. And now with the lower interest rates, although the debt level is still relatively high, the debt service cost is quite tame. But it is interesting that...
Can we go to questions?
Yes, I think we're almost there, in fact. I would just love to quickly go through the household balance sheet.
Yes, that'll be useful.
And just present to you that one should also be careful not to be just into the gloomy mood of debt only. The households in South Africa actually have much more assets than debt. That's not what you pick up if you walk the streets and you speak to people. Huh? Everybody complains about debt. But in fact, household assets, probably about 5 times as much as household debt. And so the end of the world is not with us still yet. We don't just have liabilities, we also have assets. And some of those assets are quite juicy ones and quite valuable ones. Although one should be careful to note that the pension fund and insurance interest, for instance, is not very liquid. You have to wait until you're very old or until you die before you can actually, all those who you leave behind can get their hands onto that. So, okay, I think that's perhaps enough on the household balance sheet side, just to say that the indebtedness which we witness is not the whole story. One should also be mindful of the assets. Okay, let me just conclude with these few notes. I can see that time and lunch is also in question, and allow then for any questions from the floor.